This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I wanted to take some time to talk about the full year results for A2 Milk. Now, the financial year 2021 was not a good year for A2 Milk whatsoever, and today's results basically was a confirmation that things are not great, and the next financial year is going to be a tough one as well. So in today's video, I want to break down the performance for the past financial year. We'll cover the different divisional performances, and we'll also talk about the guidance that management has given us and how the outlook for FY22 will look like. So if you enjoyed today's video, be sure to hit like and subscribe. But with no time wasted, let's get right into the video. So over here, A2 Milk is down 11.33% today. So this is the NZX listing for A2 Milk, and if you're from Australia, the current share price in Aussie dollars is $6.05. So today it was down 11% on the back of the full year results. So over here it says that the A2 Milk Company experienced a very challenging year in FY21, impacted by unprecedented levels of uncertainty and volatility due to the prolonged impact of Rona and a rapidly changing China infant nutrition market. Over the past year, China's market growth has reduced significantly from globally high rates to be flat, and cross-border trade has been disrupted significantly, which has had a profound impact on the company's results. So that's a confirmation of what we already know and that they've already told us about. But the key things to note here is that the company now expects a return to growth in the medium term. So medium term usually doesn't mean in the next years, because that's the short term. So medium term is 2 or 3 or 4 years ahead. And the outlook that the management have for FY22 remains challenging and uncertain, and it will take time to recover. So management is already telling us that things aren't going to be very good for the next year. So now let's take a look at other key points of the results. So we can see over here revenue and EBITDA was within the guidance range, but we basically have revenue down 30.3% to 1.21 billion. EBITDA down 77.6% to 123 million, inclusive of 109 million in stock write-downs and 10 million in MVM acquisition costs. EBITDA sales margin of 10.2% or 11% excluding MVM acquisition costs. Net profit after tax down 79.1%. Actions taken from the fourth quarter of 2021 to address excess inventory are proving effective. So we'll look at the numbers to see if that actually is the case. The company has also worked on replacing its executive team, so the executive leadership team appointments and Asia Pacific division reorganization to build capability and provide more dedicated management focus has been completed. Now you can look at the company's announcements as each time they replace a manager, they will have to announce that detail. So if you want to know who's changed, you can check that out. But the remaining 4 points in this statement over here, I will discuss later on in the video. But if you must know, the last point is quite interesting, as the company has decided not to return any capital to shareholders at this point in time. So now let's take a look at my spreadsheet to show you how the actual results had compared to my estimates. So over here I have the actuals that the company has performed, and what I did was I took the full year results minus the actuals for the first half to find the performance for the second half, and this basically gives us an idea of how well they've performed against their actual guidance. So they've guided for revenue and EBITDA to be between 1.2 to 1.25 billion for revenue, and EBITDA to be between 11 to 12%. So what I did was I've taken the average numbers and I've recalculated what revenue and EBITDA would be. And as you can see over here, revenue came in about 20 million short from the estimated number, and as a result of that, EBITDA also came in short, around $12 million. And the company delivered a loss of $39.4 million this second half. So this gives us a very good picture that things have deteriorated really quickly from a profit of 120 million in the first half to a loss of almost 40 million in the second half. All right, so now let's take a look at each division and how they've performed during the year. So the first one that I wanted to take a look at is China and other Asia. This makes up roughly 48% of total revenue. As you can see, revenue and EBITDA both down 16.6% and 66.4% respectively. And the reason for the decrease in both these numbers are due to the cross-border e-commerce tough comparables compared to last year. So last year what happened was a lot of these shops were pantry stocking in anticipation of the Rona. And as a result of that, now this year, it's very hard to compare because last year's numbers were artificially high, as well as that this year's numbers were affected by the rebalancing of inventory with distributors. So basically what A2 Milk did was that they reduced selling to their distributors in order to increase the pricing because they had an issue with their pricing not being where they wanted it to be. All right, and that resulted in a lower revenue number. As part of the rebalancing, they've written down 50.3 million in inventory, with the remaining inventory rebalancing by the first quarter of 2022. So the inventory levels will get to the right place where management want it to be by the first quarter next year. And a good part about this division is that China label infant nutrition sales almost 390 million, increased by 15.4% last year. And that makes up roughly 32% of total sales. So this is actually one of the divisions that is growing really well for A2 Milk. Now, if we take a look at ANZ's revenue is 46% of total revenue. It tells us a similar story, revenue and EBITDA down, but at a greater degree than China and other Asia. So revenue is down 42%, EBITDA down 68%. And the reason for both these numbers dropping was due to the Rona as well as inventory balancing in the Daigou/reseller channel. Now, the good part about this division's performance is that Australian fresh milk revenue increased by 10.8% to 169 million. And this division had achieved record market share of 12.2% at the end of June 2021. On the other hand, though, market pricing is improving, but certain wholesale traders and online players are depressing visible market pricing. So management can't actually quantify how much inventory they have left to sell, but they expect this to finish again in the first quarter of 2022. And another negative of this division is that A2 Milk's Daigou share declined 2% year on year to 22% from 24% at the end of June 2021. Now, lastly, we have North America, which only makes up roughly 5% of total revenue, so still very small. However, this contributes quite a large chunk to the EBITDA loss, and this was because of a decline in revenue due to unfavorable FX, tough comps, and a loss of a major club channel customers. All right, now I've taken some highlights from the rest of the announcement that I thought was interesting. They mentioned that there was an increase in raw milk prices, lower volumes, and an adverse mix, which led to gross profit margin decreasing to 42%. And the current gross profit margin of 42% is basically equivalent to the gross profit margin that A2 Milk was generating in 2016. This just goes to show how much of a headwind the current situation is for A2 Milk in terms of setting it back to its 2016 gross profit margins. Another key highlight is that A2 Milk now expects MVM to be loss-making till FY25. So on July 2021, the company completed the acquisition of a 75% interest in Mataura Valley Milk, a dairy nutrition business located in Southland, New Zealand in partnership with China Animal Husbandry Group. This asset is basically a manufacturing plant for A2 Milk to diversify its manufacturing capabilities from just outsourcing it to Synlait. Initially, the company had assumptions for its volume production. However, now it's revised those volume assumptions down, and the company expects MVM to only return to a positive EBITDA during 2025. So already not a very good start to the acquisition that just happened only very recently. Now, moving on to headwinds and strategy, the management team has highlighted a few. First of all, market growth is being impacted by a more pronounced reduction in the birth rate. Secondly, competitive intensity is increasing with domestic players continuing to gain market share. And lastly, the Daigou reseller channel has been impacted by the Rona, regulatory, and other structural factors. And the management team now has to figure out a new strategy to turn the business around because of these headwinds. In the past, they've relied a lot on the Daigou channel, not having to spend any money on marketing to drive a lot of sales, and that's worked for the business in the past. You see their margins being really high, roughly 30 to 31% EBITDA margins, but right now that margin has compressed due to all these short-term issues with their inventory, and going forward they'll have to spend more on marketing, more on capex, and as a result increasing depreciation. And so all of these will impact their margins at the end of the day. And because of these factors, the management team is trying to figure out a new strategy to turn the business around. And this new strategy, they've already mentioned they've been working on it since May, and they will give us an update late October. So they're taking quite a lot of time to figure this strategy out, so it'll be interesting to see what good ideas they come up with to try to turn the business around. Now, in terms of buybacks, I've already mentioned this earlier in the video. Management does not intend to pay out any dividends or initiate a share buyback at this stage, even though the company's balance sheet remains strong. And I think this is definitely a good idea. The business is not doing well, and chances are they're going to need the cash on their balance sheet and can't return that to shareholders. Now, looking at the guidance, management decided not to give us any concrete numbers in terms of group revenue or EBITDA margin at this time due to the continuing uncertainty and volatility in A2 Milk's markets at the moment due to the Rona. So as a result of that, we can't really input any numbers into our models based on management's guidance as we have in the past. So I'll talk a little bit about how I have come up with a valuation number, just a rough one later on. But over here is the forward guidance that management has given us. Obviously, there's no numbers involved. It's just whether they expect revenue to be marginally higher or broadly similar to last year. They did give us numbers for MVM's depreciation and amortization of 20 million and EBITDA loss, but obviously that's not very helpful for us to figure out the whole value of the business because MVM is still a very small percentage of the business. So I've summarized all the qualitative guidance over here. It's useful in some cases, but in the grand scheme of things, not that helpful for us to come up with a value in our discounted cash flow model. With a discounted cash flow model, you want to have reliable and good inputs into your model so that you can project out the value of the future cash flows of the business, discount it back to come up with a fair value for the business today. If you have bad inputs into the model, then you get bad outputs. And what this does is it gives you a false sense of security. So say, for example, I come up with a number and say it says that the value of the business is $6, then I would think, if I buy around $6, I will be safe. But because there's so much uncertainty involved with the business going forward, there's a wide range of outcomes. And when there's a wide range of outcomes, there might be a chance that you may actually make a loss or you forecasted the number incorrectly. And what happens if the business is only worth $2? And that's the dangers of using a discounted cash flow on a company that doesn't provide high quality earnings and high quality future guidance. So for the purposes of today's valuation, I won't be using a DCF model because rubbish in, rubbish out. So instead of going from free cash flow to figuring out the equity value of the company, what I'm going to do is I'm going to go from the equity value of the company, figure out an appropriate PE ratio that I'm willing to pay for the company, calculate the earnings, and assess whether the earnings that I'm paying today is reasonable. So I'm going to explain my process using this example over here. So with A2 Milk, the current share price is $6.34 per share. This represents a market cap of $5.17 billion or $5,170 million. The current PE ratio that I'm willing to pay for a company like A2 Milk at today's quality will be around 15 times. All right. So if it's a better quality business, then you'll pay obviously a higher PE for its future growth prospects as well. But for A2 Milk, it doesn't look like it's going to grow over the next few years. So I'm only going to pay 15 times earnings. So on a 15 times PE ratio, the company must be earning $344 million in after-tax earnings. So this is calculated by taking the market cap divided by the 15 times PE ratio to come up with an earnings earnings for the company. And the next step of this process is to compare it to its previous historical net income and see where the current earnings that I'm paying for lies in terms of its historical performance. And looking at A2 Milk's historical performance, the closest earnings of 344 million is in July 30th, 2020. So last financial year's results, where the company delivered a net income of 385 million. So the current earnings that is implied by my valuation that I'm paying for this company today means that the company has to return to an earnings level that is pretty much at 2020 levels. And I ask myself, is that reasonable given the current headwinds that the company is facing with lower birth rates, with the Daigou channel being shut out, with increased competition and very low visibility going forward from the management team? Chances are that's probably too much for me. So in order to reduce the earnings that is implied by today's valuation, I either have to increase my PE multiple that I'm willing to pay for the business, which is unreasonable because you're not going to pay more for a quality of a business that isn't as good. So the only other reasonable alternative is to pay a lower amount for the business by reducing the market cap. And so that's how I would think about the valuation of A2 Milk. But at today's prices, at a PE of 15 times that I'm willing to pay for the business, it is too expensive for me. So obviously this will depend on how much you're willing to pay for the business today for its future earnings. And for me, at current prices, it doesn't reflect good rewards to the amount of risk that I'm willing to take. For full disclosure, I don't own any shares in A2 Milk. However, I do have A2 Milk as one of my top 5 picks for the stock picking competition this year. So as a result of that, my performance, it won't be very good this year because A2 Milk has not done well at all. Alright, so that's my current thoughts on the valuation. Now, the last thing that I wanted to talk about is the A2 Milk potentially becoming a takeover target. So a few days ago or last week, the Australian newspaper reported on Sunday night that A2 Milk has been on the radar for potential suitors this year. Swiss multinational Nestle is keeping a close eye on A2 Milk, and Kieran's Lion has also looked at the company in the past, although both had previously thought the price was too high. So now that the price has come down a little bit, we might see a takeover offer or of some kind for A2 Milk. And I think that might be one of the reasons why the A2 Milk's share price might actually be surprisingly strong over the next few weeks and then months ahead because of that potential takeover offer that you might receive. But for me personally, the rewards relative to the risk that I'm taking is not high enough, and I am sitting out A2 Milk at the moment. So anyways, let me know what you think about A2 Milk in the comment section down below, whether you're buying, whether you're selling. Always keen to hear your thoughts. But thank you guys for watching. Until next time, take care.